Hi everyone. In today's video, we are going to study Chapter 5 and Chapter 6 of Consolidation, that is, Associate and Joint Arrangement and Foreign Currency Transaction. So let's start with Chapter 5. Here we have objective to explain what associate and joint arrangements and how to account them. Definition, we have associate and joint arrangement. Relevant standard, here we have IFRS 11 joint arrangements and IAS 28 investment in associate and joint ventures. So relevant standards, we have associate. In associate we use equity accounting. Under joint arrangement we have two options. First is joint operation, second one is joint venture. We will see that what is the meaning of joint operation and what is joint operation exactly it is. So here that accounting treatment we have under joint operation, that is IFRS 11 line by line. Recognize own asset and liabilities as well as income and expenses separate line. And joint venture, IAS 28 equity method. Recognize profit and loss as we do in equity accounting, same as it is IAS 28 associate. Definition, associate an equity over which the investor has significant influence. So significant influence, we know that we need to own the shares between 20 and 50%. Joint arrangement, we have an arrangement in which two or more parties have joint control. So in joint arrangement, two or more parties have joint control. So these points are important for the exam because we need to write the definition if they are asking. Now, an investor may not have outright control over an investee, but may still have a degree of influence. Where an investor has significant influence, the investee is an associate. Where an investor has joint control, example, it shares control, the investee is a joint arrangement, either a joint operation or a joint venture. So first, investor has significant influence. The investee is an associate. So when the investor has significant influence, so the investee will become an associate. Where an investor has a joint control, example share control, the investee is a joint arrangement, either a joint operation or a joint venture. Equity accounting may therefore be applied in both the separate and consolidated financial statement of an investor in an associate or joint venture. Relevant standard, we have the IFRS accounting standard relevant to associate and joint arrangement are IAS 28 investment in associate and joint ventures defines significant influence and provides guidance on equity accounting procedure. So here what IAS 28 does, define significant influence and provide guidance on equity accounting procedure. IFRS 11 joint arrangement define joint control, provide guidance on determining whether a joint arrangement is a joint venture or a joint operation, and explains how to account for joint operation. And IFRS 12 disclosure of interest in other entities is also relevant. Why not joint venture? Because for joint venture we use equity accounting, IAS 28. So here explain how to account for joint operation only under IFRS 11, not joint venture, because under joint venture we use IAS 28. Now associate. Definition, IAS 28 investment in associate and joint ventures define an associate as an entity over which the investor has significant influence. Significant influence is the power to participate in the financial and operating policy decision of an entity. A holding of between 20% and 50% of the voting power is presumed to give a significant influence. Accounting for associate. Associate are accounted for using the equity method. A statement of financial position. Cost of investment we have. Post share of increase in the net asset. Dividend paid we subtract, impairment we subtract, and unrealized purchase. And unrealized purchase on a stock, parent is seller. So parent is seller means here associate is seller. Okay. We need to subtract this and balance of investment in associate. This will be the carrying value. Note share of increase in the net asset means whatever we have like retained earnings. Okay. So whatever we have retained earnings or post acquisition profit, we need to, for example, we own 30%. So company earns profit of 100,000. So 30,000 will be our post acquisition share of net asset. That is called a post acquisition increase in the net asset, also called profit. Unrealized profit is always on unsold stock. Parent is the seller. Okay, now let's understand how parent is sold. Downstream, first parent to associate. Okay, when parent to associate, eliminate 100%. They have mentioned here unrealized purchase on stock if parent is seller. So whenever parent is a seller, then we need to eliminate 100% of unrealized purchase, entire amount. Okay. Now, so this one is downstream and another one is upstream. Upstream means associate to parent. In the first scenario, parent sold to associate, and in the second scenario, associate sold to parent. So in this scenario, we need to eliminate only the investor portion, means parent portion. For example, parent owned 30%, so we need to remove 30% only. Profit or loss include the group share of the associate profit after tax less any impairment losses. Joint arrangements definition. Joint arrangements are defined in IFRS 11 joint arrangements as arrangements where two or more parties have joint control. This exists when the relevant activities require unanimous consent of the parties that share control. So the unanimous consent required from the parties who share the control. Joint arrangement. Under joint arrangement, we have joint operation and joint venture. Ventures have right to asset and obligation of the arrangement. Account for share of assets, liabilities, income, and expenses. Under joint venture, we use equity accounting. Under joint operation, we account for share of assets, liabilities, income, and expenses line by line. Ventures has right to net asset of arrangement. Joint venture is normally a separate entity. Now, joint operations. Venture has right to assets and obligation on the arrangements account for share of the assets, liabilities, income, and expenses. Next, we have joint venture. Venture has right to net asset of arrangement. A joint venture is normally a separate entity. Equity account same as associate. IFRS 12 disclosure of interest in other entities. IFRS 12 outline the disclosures required when one entity has an investment in another. So we need to disclose the interest. Now IAS 27 separate financial statements. IAS 27 applies when an entity has interest in subsidiaries, joint venture, or associate, and it prepares separate non-consolidated financial statements. In separate financial statements, investment in subsidiaries, joint ventures, or associate can be accounted for in one of the following ways. So we have three options. Cost, IFRS 9, fair value through profit or loss, or fair value through OCI, and equity. So first one is cost method, second one is fair value IFRS 9, financial instrument, they can select any of them, and using the equity method. But this is for a separate financial statement. But in the consolidation, they don't have any choice. They must have to select cost method. Okay. Note in the group account, parent always keep its all investment, whether subsidiaries, associate, or financial instrument at cost means it will recognize at cost only. No choice. But in separate financial statement, they can select any of this. Now, if parent is using fair value through profit and loss, retained earnings will be affected by any change in fair value. Increase, then retained earning will increase. If parent is using fair value through OCI, then OCE will be affected by any change fair value Increase means increase in OCI reserve. So increase in OCI reserve. It's not like that. It like accumulated in OCE and equity reserve will increase. That's how it will affect. Yeah, so it is simple. So first any fair value increase will goes to OCI and then accumulated to OCE. Now significant influence. So the power to participate in the financial and operating policy decision of the investing. So they have the power, but not control or not jointly control of those policies. Now, Chapter 6 of Foreign Currency Transaction. Foreign currency, IAS 21 defines two types of foreign currency, functional currency and presentation currency. Definition, foreign currency, a currency other than the functional currency of the entity. So this is the simple example of foreign currency just to understand, but do not write like this in exam. Functional currency, the currency of the primary economic environment in which the entity operates. You may also write like this, but try to add more words. Okay. Functional currency. This is important definition. The currency of the primary economic environment in which the entity operates. Now, presentation currency, the currency in which the financial statements are presented. An entity can select any currency to be its presentation currency. However, its functional currency must be determined by applying the guidance provided in IAS 21. Now, determining functional currency. Exchange rate, closing rate, the spot exchange rate at the end of the reporting period. And export exchange rate, the exchange rate of immediate delivery. So the closing rate is that spot exchange rate at the end of the reporting period. So whenever we have the closing date, so that date transaction and that date conversion, sorry, that value will be the closing rate. Okay, and export rate is that at the time of transaction, what is the exchange rate, that will be the spot rate. Okay, now functional currency and transaction currency rules. Now functional currency definition as per IAS 21. The effect of changes in foreign exchange rates states that functional currency is the currency of the primary economic environment where an entity operates. Importance of functional currency is other than foreign currency. Every currency is foreign currency. So the importance of functional currency is other than foreign currency. Every currency is foreign currency. Presentation currency can be more than one. It is depend upon the number of location where our stock is listed. For example, India, US, UK, any country. So presentation currency can be more than one. Okay. Now factors used to determine a functional currency are as follow. So what are the factors? So factors we have sales price, receipts, competitive forces, purchase and cost, and financing. So the sales price, what is the price of our product in that currency? So receipts means whatever we have sales, purchase, all those receipts we generate. So that is in which currency, and sales price in which currencies we are setting the sales price in which currency, and competitive forces means all those we have competitor in which particular currency they are selling that, and purchases and cost, which in which currency we are purchasing and in which currency we are incurring cost. So this is all that functional currency. And also financing, in which currency we are getting financing. Now recognition of foreign currency, majority of sales is in, majority of payment to supplier, majority of expenses, substitute product available in which currency generating operating receipts, cash, in which currency we raise in the finance. Competitive force, it can not only be competitor, it can be product or seller. A subsidiary that operates with the little autonomy will most likely have the same functional currency as its parents. Little autonomy means less freedom. Okay, they don't have that much power to take their entire decisions. Okay, for example, parent is in US and subsidiary in UK. But whenever subsidiary needs financing, they ask parent to give them and they got money in USD. If they want to decide the selling price, parent is the one who helped them to decide the selling price. Parent is the one who helped them in each decision taken by parent. So the scenarios subsidiary is not operating separately, then functional currency of parent will be the functional currency of the subsidiary. Same transaction rule, we have overseas transaction. Initial transaction translate into functional currency using a spot or historical rate. Settlement translate the settlement into functional currency using the spot or historical rate. If unsettled, the treatment depends upon whether the overseas item is monetary. If monetary, example receivables, payables, monetary means value is fixed in the monetary amount. Okay. Loan receive, for example, receivables, payable, loan retranslate at the closing rate of exchange. If non-monetary means here value not fixed in monetary term. So this is non-monetary. Example, PPE inventories do not retranslate. However, if held under a fair value model, then the fair value will need to be translated when determined. Okay, so when we will determine the new fair value, then we need to translate. Now exchange rate, for PNL we take average rate. Okay, for balance sheet non-monetary item we take closing rate. Okay, for balance sheet monetary item we take historical rate. Now exchange difference, item fair value gain or loss and exchange gain or loss. Financial assets or liability at fair value through profit and loss. Monetary item we have fair value gain or loss, PNL we have here in this, and exchange gain or loss again we have PNL. So the effect will be fair value gain or loss will goes to PNL and exchange rate gain or loss will goes to PNL. Now financial asset or liability at fair value through OCI. Monetary item again fair value gain or loss will goes to OCI and exchange gain or loss will goes to profit or loss. Now PPE under revaluation model, non-monetary item we have fair value gain or loss will goes to OCI subject to IAS 16 requirements and exchange rate gain or loss will goes to OCI. Investment property fair value gain or loss will goes to PNL and exchange gain or loss will goes to profit or loss. Thank you for this video. In next video we will study chapter 7.